I started, let me give you a little, oh, there you go, Missouri, all right. Well, I'm coming to you from Chicago, Illinois, and home of the Chicago Mercantile Exchange, now one of the biggest exchanges in the world, okay? Let me give you kind of the 2-minute version of where I started, and the only reason I'm going to do that is because I think it will help you understand the kind of concepts, logic, and rules as we go over them, okay? So what we're going to be doing today is really going over just a very basic set of rules, which I think you'll see, I kind of recognize some faces in here. There are some people in this session today that I think only use these rules and nothing more. It may sound very simple to you, but I think you'll find that when it comes down to it, all that really matters is, I shouldn't say all that really matters. The most important thing in trading is identifying price levels where either you have more willing buyers or more willing sellers, okay? Understand that the movement of price in any and all markets is simply a function of an ongoing supply and demand equation. No different than how we buy and sell things and price things in every other part of our life. When we go to the market to buy food, when we buy a home or a car or something like that, it's all a function of this ongoing supply and demand equation, right? Therefore, if you understand that, you'll also understand that the most significant turns in price happen at price levels where supply and demand are out of balance. Our job today is going to be 2 things. Number 1, be able to identify price levels where supply and demand is out of balance, which is exactly where prices turn, right? We need prices to turn for. And then number 2, come up with some very simple rules to take advantage of those imbalances. Because after all, as market speculators, no matter what time frame we're trading in, be it day trading, swing trading, longer term position trading, okay, all we are really doing is identifying markets where prices are at levels where supply and demand is out of balance, and we're simply trading them back to balance. Does everybody understand that? Okay. All right. So let me paint a little visual for you, just so you can kind of understand the reality of what's going on here. So I started on the floor of the Chicago Mercantile Exchange, right? Now, if you wanted to, there's a lot of things you can observe and learn from that experience. Okay. Remember, at that time, I wasn't looking at charts. In fact, I didn't even know there were charts. I was looking at 3 things constantly all day long. No matter where I looked, I saw people trading, prices moving, and orders going in and out of the market. Okay, those 3 things constantly. So let's say you're standing in a trading pit, maybe the Japanese yen, right? And you're in there in the morning. You're thinking, okay, it's time to go to work. It's time to jump in the trading pit, the yen trading pit, which I was right outside of that pit for a long time. In fact, that's the market I started trading. That was the first market I ever traded, was Japanese yen. Anyway, so if you're in there and you want to, you're going to start trading, right? Well, what's something you might want to look for? Okay, now you have choices. You can learn everything there is to know about the Japanese economy. You can get a kind of a real-time news feed from Japan and the Bank of Japan and all that stuff, and make sure you're really on top of what's going on over there. Okay, you can learn about everything you need to know about Japan, right? You can learn all that stuff and try to make decisions that way, or you can you'll go in there and you'll look for the there's 2 types of traders in a trading pit. There's the individuals in the pit that are trading their own accounts, and there's the filling brokers, which are kind of on the outside. But those are the guys that are filling orders for institutions, banks, and all those big groups, right? Money managers and stuff like that. So those guys are doing the big orders. They have the big stacks of orders. So if you're a smart market speculator in a trading pit, you're probably going to be watching, if you're brand new to the pit, you're probably going to spend your first day or 2 figuring out who the biggest filling brokers are in the pit. Does everybody understand so far where I'm going with this? Okay. Now, when you see who these people are, and there's probably only 2, 3, or 4 of them, right? Not too many. I'm talking the big ones. All you have to do is watch where they're bidding for bidding in the market. Watch what price levels they are buyers at. Watch what price levels they are sellers at. Okay? When you start to see the size of the orders that they're, of the size that they're bidding for at specific price levels, you know exactly where the real demand and real supply is in that market. Okay? Does everybody understand that? Okay. So if you see the yen, whatever, trading at, I don't know, 88.50, okay, and all of a sudden it drops down to 88.40, and you see the big filling broker in the pit. Now I'm talking about the futures, for example, okay, which is just, same market as the spot, just doing it through the futures. But let's say prices drop down to 88.40. All of a sudden, this big filling broker has this giant stack of orders in his hand, and he's bidding for some pretty big size right there. You, as a smart market speculator, where are you going to be buying that day? Where are you going to be a willing buyer that day? Where is the safest, low risk, high reward, high probability price to buy at that morning? What price level is that? Right? What price level though? Where are you going to be a buyer? Right? This guy's bidding. Right. This guy's bidding at 88.40. Right? You want to be buying at 88.40, right? Is everybody with me here? Okay. Yeah, you want to be buying at 88.40. Okay. Right. Okay. Now, as long as you keep buying there, you're probably going to be okay until that broker doesn't have any more orders to fill at 88.40. Make sense? Now let me ask you this. If you also know where the big stack of sell orders are, where the real supply is in that market that day, just by observing where the real buyers are, where the real sellers are, do you need to know anything else to make money that day trading that Forex market? What else would you need to know? Do you really need any more information? Okay. No, you can really keep it that simple. So, but the question is, the problem is, we're all sitting here on the web, connected all around the world with this big web, right? The internet. We're not in a trading pit. So what do? Well, the answer is you figure out exactly what the picture of that big stack of orders or that supply and demand imbalance looks like on a price chart. And that's exactly what we're going to do right now. Okay? And so why did I kind of spend 5 minutes telling you that little story there? Well, it's important that when we now look at charts in candlesticks, okay, in the next few minutes, that instead of looking at candlesticks and conventional technical analysis the way you always have, remember, the only way you're going to make money trading anything is if you have a significant edge over your competition. If you're buying and selling where everybody else is buying and selling with the same rules that everybody else is using, looking at candlesticks the same way everybody else does, good luck. It's very difficult, if not impossible, to make money consistently doing that because you're just buying and selling where everybody else is. So let's work on building that edge, okay? And again, start to translate that real demand and supply onto a price chart. I'm going to start with one PowerPoint slide here, and then we're going to learn from this slide, and then we're going to go into the real markets, the live markets, and start to apply what we're looking at. So hang on, I'll grab this for you. Okay, we'll make this part lesson and then part application. Can everybody see that PowerPoint slide? Just so before I start talking away here. All right, great. Thanks for spending some time with us today, too, by the way. It's probably the middle of the day for some people. All right. Okay. Yeah, so we all need to kind of have our own edge, but my hope is that you can take what we learned today, what we go over today, and start to incorporate it into what you're doing. And my hope is that this will help give you the edge that you need to be successful, no matter what type of trader you are, short-term, long-term, swing trader, whatever. Okay, let's take a look. So last question here. Can everybody see my arrow as I move it around? Just making sure. And then I'll be done with questions. All right, thanks. All right, let's begin. So we have a chart here, okay? Let's go over some rules. And let's go over some real simple steps, okay? So step number one, we want to identify the price levels where demand exceeds supply and where supply exceeds demand. If we look down here at the bottom, we have a drop in price. Okay, everybody should be able to see this. We have a drop in price, a little period of sideways trading, and then a strong rally away from that level. Okay, whoops. Something happened to the chart there. Let me grab it for you again. Hang on. There we go. You should have it now. Okay. So we have a drop in price, some sideways trading, and then a strong rally in price away from that level. Okay. So our pattern is drop, base, rally. Not rally, base, rally, but drop, base, rally. Okay. Now, down here at the bottom in this cluster of trading here, why is it that prices only stayed here for a short period of time? Okay? Remember, supply and demand appears to be in balance here, but the truth is it never is behind the scenes. On a dealer desk, at a bank, wherever, it's not in balance. It just takes a certain period of time for this unbalanced equation to play out. Once prices rally away from this level as they do, we let this rally happen. And once this rally happens, that's when we can say, aha, we now know where the real buyers are, where the real demand is. Okay? Remember, the only reason why prices rally away from this level as they do, there is a giant stack of buy orders there, tons of demand. Okay? Demand exceeds supply. Once you run out of sellers, price will rally away from that level. This is the broker in the pit that has that huge stack of buy orders. The problem is he's got too many, and there's not enough sellers. Okay? All right, let's one more time. There you go. Okay. So now we need two things. We need to identify demand, which we did. Now we need to identify supply, which is up here. This is the origin of the last drop in price. Rally, base, drop. Not drop, base, drop, but rally, base, drop. Just like here, we're looking for drop, base, rally for demand, not rally, base, rally. Okay, very important distinction there. So here's our supply up here. Here's our demand below. The distance between the two is our profit zone or profit margin. Okay. And last but not least, we want to identify the trend. So hopefully this whole picture here is in an uptrend because we're going to go over the buy setup in just a minute. Okay. We want this whole thing to be in the context of an uptrend. We want to identify where our demand is, our willing buyers, and our supply, our excess amount of sellers. Okay. Now, before we move on for rules of entry, okay, and I'll get to some questions in just a bit. Maybe you've heard the term support and resistance, and you kind of know those, and you get it. Maybe you hear me come in and talk about, use the words demand and supply. Maybe that helps solidify it for you a little bit more. But if that's not enough, let me give it to you one more way. Not sure what keeps happening to the chart here. It keeps kind of going away. But there we go. So now maybe you've heard me use the terms demand, supply. Maybe that helps you a little bit more. But let me give it to you one more way really quick. When we buy anything out there, anything in the world, would we, in our everyday lives, would we rather pay wholesale prices or retail prices? What would we rather pay, wholesale prices or retail prices? Okay, right, wholesale. Exactly. Okay. Well, this is wholesale down here, right? Okay, this is wholesale down here. Okay, if support and resistance doesn't do it for you, if support doesn't do it for you, demand doesn't do it for you, maybe you relate to the word wholesale better. Call it wholesale. That's what it really is. Just the opposite up here. These are retail prices. Okay, you don't have to call it resistance. You don't have to call it supply. You can call it retail. That's what it is. Hang on 1 second here. I'm just going to fix this chart. Okay, sorry about that. Not sure why this keeps flicking off like that. Just like flickers away. Okay. So we got wholesale prices and retail prices. Okay. Remember, if we were to chart the way any successful business that's in the business of buying and selling things for profit makes their money, this is exactly what the chart would look like. Okay. One of the biggest misconceptions in trading is that, somehow this is different than how we properly buy and sell things in every other part of your life. And that could not be further from the truth. Okay, so just because we have a demand level here and a supply level up here doesn't mean that we have a quality trading opportunity on our hands. Let's run through a couple things. First of all, wouldn't it be nice if we could look inside these candles and see how much demand was really here? Wouldn't it be nice to do that? To see exactly what the banks have there on the demand side and all that? Let me walk through one more thing here, and then I'll get to some questions. Okay. So we need to know that we're in an uptrend if we're looking to buy. We want to make sure that there's a lot of demand at this demand level, and we look to how prices left the level to tell us that. And then the third thing here that is absolutely crucial, okay, absolutely crucial, is that we need to know that we have a significant profit margin. So just because we have a quality demand level and a quality supply level does not mean that we have a trade, okay? All right, does not mean we have a trade. We want to make sure that the risk reward is ideal. In other words, for me, for example, okay, I want to make sure that I have at least 3-to-1 reward to risk determined profit margin, right? Profit zone or profit margin, okay? Because this rally is really eating up or absorbing all the significant supply to the left. All right? Now the easy part, okay? Now the easy part. Getting all that down, once you get good at that, you're good to go, okay? Now, how you actually enter these trades? Okay, let's get into that right now. Again, I apologize. I'm having this trouble with these charts. I have to re-grab this chart like it's been almost every minute since I started. So I'm doing that and trying to stay on the right path here with what we're talking about. So, okay. So when price comes down to this level, there's two ways you can enter this position. What I typically do is I will just enter right at the top line here, right at this white line, right at the top of the area here, with my protective sell stop just below the level, okay, just below the area right here, okay? And then, of course, target 1 is going to be the opposing supply level. And actually, in reality, it looks like you just get out of your position right here at 2.2. But in reality, I would go just before that. Because at supply or resistance, there is competition to sell at supply. So if I'm selling my long position, I don't want to sell where there's competition to sell. I'll get out a little bit before and leave some room for the next guy, right? So that's just me buying right at the top of the level with a stop just below. But here are some other ways that I see people doing it that are in our trading group here in our trading room. That's the extended learning track and online trading academy I'm talking about. Some people will use more of a confirmation entry, which means they'll let prices come into the level and then buy as prices leave the level, getting a little bit of confirmation. So letting them dip into the level and then buying when they leave the level, but also having their stop just below the area, right? Okay, that's another way to do it. Now, what other people will do is they will scale into the position, meaning they might, so I've seen some people enter part of their position at the top of the level, maybe half there, and half of the position halfway into the level, again, with the stop just below the level, okay? It's another way to do it. What doesn't change is where the stop is and how you take your profits, okay? There were a few questions about moving stops to break even. There are a number of ways to do that as well. Whatever you do, just make sure it's in your trading plan and you're very consistent. One thing that's pretty popular that seems to work out pretty well is once you reach target 1, move your stop to break even. Okay, it's typically what I look to do. Okay, once you reach target 1, moving your stop to break even. Other people will say once I reach once I've achieved a 2-to-1 profit, meaning once they've achieved twice their potential loss, they'll move to stop to break even. Okay, that's another way to do it. Okay. Jason, well, again, one of the important things here, let's kind of go over notes over here to the left. And your question is answered right here in these notes, these rules. Let's go number 1. Identify demand supply trend and determine profit margin. We've talked about all those things pretty quickly right here. Number 2, limit opportunities to the first pullback in price into demand, and that's kind of what you're. That's more of an answer for your question, Jason. So, on your significant levels, right, the ones where prices really left that level in strong fashion, they're well placed in the big picture curve. You're trading with the trend. Note those are going to be some of your better trades, and with that, often price is not going to penetrate deep into the level on the first pullback. So if you're constantly taking the first pullback, you're probably going to notice the price, typically doesn't go too deep into the level on that first pullback if you're, if you're following the rules. Okay. All right. Yeah. So next, once price declines into demand, you buy. We talked about that. Once entry occurs, protective stop loss is placed just below the level. We talked about that. Enter first and second profit targets to sell orders. I'm showing you one here. Your next one would be above at the next opposing supply level. Okay. And down here, initial profit zone or profit margin must offer 3-to-1 risk reward to the first target. Now, again, that's personal preference. So you put in whatever you're comfortable with there, and make sure you just stick to it. Okay. All right. Okay, so let me get to a couple questions here, and then we can move on and start to apply this stuff in the live market. Okay, but it's with all this stuff, one of the big I think flaws of trading education is that everyone's just so quick to get into pattern recognition learning, and they skip the most important part, which is the logic and the concept, right? So you have to learn how to properly think this stuff before anything else. All right, let me just. Yeah, so Pitmull, great question there. How is lot sizing? Very important question there. So what we do with that is you measure the distance from your top of your demand zone to where your stop is. In other words, measure your distance from entry point, which is right here, to your protective stop, which is down here. Now that amount of pips is always going to be different depending on the size of this level. All right? Sometimes it may be, and also depends on your the time frames you're looking at, which mean, whether you're a day trader, swing trader, longer term position trader. So maybe you're a day trader and one day you have a level that's maybe 10 pips wide. So maybe your stop is 12 pips, you know what I mean? Or maybe you're a swing trader and you're looking at a 20 pip level and your stop is 25 pips wide. You see what I'm saying? So Pitmull, measure the distance from entry to protective stop, okay? And then calculate your position size. And you're doing that to make sure that you never have a higher percentage of your account that you're willing to risk. So you might say, you know what, I'm only going to risk 1% of my account on every trade. Okay? So you're going to come up with that number and do the simple calculation to make sure that you never have that, more than that at risk. Okay? Let's see. In this chart, would you buy if price comes back to 130 where the last rally started? That would be the second pullback into this level. Okay, so I would stick to the first one there, but that's just me, AB. You can always take the second pullback if and only if price barely touches this level the first time it turns. Remember, we constantly want to be assessing how much demand, how many orders are really there, and the price action really gives us much of that information. Okay. Let's see, Philippe. What if price stabs briefly a tiny bit through below support zone but quickly closes above, leaving a very bullish setup, still buy? As long as you don't get stopped out, but I wouldn't, make sure you have your stop in there. And also, too, maybe you're trading a market maybe you're trading a pair that's thinner than, say, the euro against the dollar or something. In those cases, you might need a little bit wider stop just because you're dealing with a thinner market. Okay. Let's see, the other question there about retracements. What we're talking about with retracements there, the retracement is just this pullback in price. So the word retracement, kind of means the same thing as pullback. That drop in price back into demand level, that's the retracement. Again, we typically want to focus on that first retracement back into the level. Okay. Okay. And one or two more here, and then we'll move on to the live market. Correct, Chewbacca. Exactly. Okay. So yeah, if you find that your demand, let's see, when you find your demand. I actually, I'm not sure if I understand what you're saying there. Whatever the width is, your distance from entry to stop, let's say, I think you're saying it's 100 pips. Yeah, you want to see at least a 300 pip rally away from that level. And that's what will give you that 3-to-1. Okay. The buy would be the first pullback there, English. Okay. And let's see. Yeah, GRM, I see what you're saying there with resizing your window. I have to do the same thing. I don't know what's happening there. All right, let's go over to the live markets here. Actually, before we do that, let me just show you one more here. And let me just show you an example of one of the students in our I just had this laying around, so I thought I'd share it with you. This is one of the students in our trading room, right? XLT program. He says, I was in the Sunday Forex XLT yesterday. I took the long position on pound Swiss that we reviewed in class. I took 2 contracts. I happened to find myself up $2,800, 6 a.m. Tuesday morning. Thanks for the great class and pointing out the pound Swiss. I was leading that session, and let's see here. There we go. So you should be able to see this new chart. So notice over here, drop, base, rally. And if you review the recording of this trading session we had, we pointed out that this was a strong rally in price away from this level. Okay. Now this XLT member bought right here when prices came back into the level. This is a daily chart. So this is more of a swing trade, and had a nice profit on this trade. But notice the price did go pretty deep into the level. Okay, price went pretty deep into the level. So he used the set it and forget it approach. He used the set it and forget approach, and what I'm getting at is, without pre-planning this stuff, okay, without pre-planning this stuff and putting those orders out there, I doubt very highly he would have been able to have that profit, okay? So you need to make sure that you're just following the rules that we just set up in here, and, all right, let me get to the live charts here. So he just bought at the top of the line there. He didn't wait for prices to come into that area or not. I mean, he didn't use the confirmation entry. He just put a limit order out there. That's all. Limit order stops and targets. Okay. All right. So everybody can see the live charts now. Hopefully, can everybody see the live charts? Okay. Good. All right. Let's move on here. And we can really look at the market doesn't matter. That's the euro. Everybody looks at the euro. Why don't we look at something else here? I'll pull one up here, and we'll start to do this. Okay. Pretty much SBLA there. Buying in uptrends, selling in downtrends. Right. The odds are stacked in your favor that way. Okay. All right, let's go to this one right here. There we go. Here's a level right here. Let me point this one out to you, and then we can look at any market you want to look at. I really don't care. I'm just kind of bouncing around here. Okay. Let me just answer one more question here. Yeah, Ben, I would go with the low there. It's lower risk. It's higher reward, right? Okay. Bill G, yeah, I just didn't see it. I'm sorry. If you wouldn't mind copy and pasting it in there, I'll try to make sure I get to it. Okay. Now, if there's no trend, you're just selling at resistance, supply, buying at demand, right? Let's take a look at this chart up here. So we're looking at the dollar Swiss. Okay. Now, let me share something else with you here. How we draw our lines is very important. Okay, I'll try to put a setup out here that hasn't met entry yet. Okay. Now, when we look at, let's see, there we go. So when we look at the kind of the daily chart here of pound Swiss, we've just been drifting lower and lower and lower. When I come down to the 30-minute chart on top, okay, I see we have a nice supply level above. So does this meet our pattern of rally, base, drop? Yes. Are we in a downtrend here in the bigger time frame? Looks okay. How did prices leave this level? Was it a strong drop in price? Right? Was it a strong drop in price, or was it more of a gradual decline from that level? How does this area right here look to us? Okay, this one right here. Remember, this helps quantify the level of imbalance, right? So hopefully you can see the circle I just drew in there. Okay. All right. Yeah, so kind of medium to strong supply, I agree with you. Nice strong drop in price here from this level. Okay. Next, so at this point, we probably feel like we have a decent level on our hands to trade off of. But there's one more thing we have to do. We have to figure out where our opposing demand level is to make sure that we have at least a 3-to-1 opportunity in this market. Okay. Now we could take a look down here. Let me just put a line down here. Okay. All right, so I just drew in a demand line down there at the bottom. Let me draw on one more set here. That was kind of target 1, and I think there was another one just back here for target 2. Right in here. There we go. Okay, let me, oops. I'll grab this picture again. There you go. Okay. All right. Okay. Yeah. Okay. All right. So yes, we have our supply level up here. A couple demand levels below. Again, if the risk and reward meets your criteria in your trading plan, and everything else is in line that we talked about, you just push the buttons. And as long as you're taking every trade according to plan, it's really hard to get into a lot of trouble doing that. Usually, almost always, the reason why people run into trouble is because they're getting out of they're letting their losers run, and they're getting out of their winners too quick. You don't want to do that. Okay. Yeah. So I see what you're saying here, FX traders. So the dollar Swiss almost hit this level up here. You see how it almost went up to this level but didn't? Now, what does that tell us? Well, from my experience, often that's a pretty good sign. That means that, you know what? There's so much supply up here, price could barely get up there, and it couldn't even reach it, and then it turned. You see what I'm saying? Okay. So anyway, this is an example of how we do this. Now, there's a couple little notes here that you really need to be aware of. Now, I'm going to blow this chart up, so these are the little nuances that if you don't know them, it's tough. If you do, you have a pretty big edge. Okay. So notice this top zone right here, this supply zone, and I will. Let me do this. There we go. All right, and I know we're spending a lot of time on this dollar Swiss. I didn't really want to do that. There's better setups out there, but anyway. So this is supply zone. So let's talk about how we draw our lines, right? I think FX Trader, you're talking about the wicks there. Okay. So let's talk about how we draw our lines. It's very important. Okay. So notice on the top of the level, I just put the top black line on the top of the wick here, right? Okay. On the bottom black line, I cut right through the wicks. See how I cut through these wicks here, but I didn't do it up here? Okay. Yeah, so you might be thinking, well, why not just move your black line right down there? Now you're consistent. Now you've got all the trading activity in between your two lines. Well, the reason why I like to put it, kind of put it up in there, you see how now I'm cutting off these wicks? Can everybody see that? Right? I can even blow this up a little bit more. There, how's that? Okay. So there's a reason why we do that. Let's talk about that for a minute. So let's talk about the bottom line first. So why put the bottom line snug up against the candle bodies and not down here by the wick? Well, there's a reason. Now think about it. Who do you want to trade to? Who do you want to? Oh, the chart's not updated. Okay. Who do you want to trade? Who do you want to sell to? So you're selling at supply. That's your entry. But who do you want to sell to? Who do you want the buyer to be? You want the buyer to be a consistently profitable trader or a novice who has no idea what they're doing? You see what I'm saying? So here's what I'm getting at. If I keep my bottom black line right there at the bottom of the wick, I would be selling to a buyer who's kind of buying pretty close to the supply level, right? They're probably making a mistake. However, I would rather sell to the buyer. Let me show you, recapture the chart. Now I've moved the black line, okay, to up here. So now I'm putting the bottom line for supply snug up against the candle bodies. So now that forces me to sell to a buyer who's making a big mistake, a really big mistake. A buyer who's buying after a big rally in price and right into the meat of the order flow. Does that make sense? So for supply, we want our bottom black line snug up against the candle bodies, and we want the top black line to be on the high price in the base, right? The high price in the area. By putting the bottom black line where we do, it forces us to trade with people who are making very big mistakes, who have no idea what they're doing. By putting the top line at the highest price and then our protected buy stop just above that level, we're giving ourselves the best chance in the trade. Okay? All right. All right. Coco has a really important question here, it looks like. That's got to be 20 question marks there. Let's see. On the lower time frame, how do we know which level would price rally to before we take the short? Yeah, I think you're talking about this level here. So I don't know I don't know which level price is going to hit first. Okay, but the point is, and nobody does. If you hit the supply level up here, and it meets your trading plan criteria, we would bet on a downside move to this level in here. Okay. Now, if you may be asking about multiple levels that are kind of on top of each other. That's something we spend a lot of time on in the trading room. Let me give you the kind of the short version here because of time. When you have levels on top of each other, okay, it's usually ideal to take the outer level. Now, first of all, that situation where you have levels right on top of each other, that's a really good situation. We just had that in the yen last night, right? You kind of had two thick levels right on top of each other, and you had a really, really nice turn in price in the yen. So when you have two levels on top of each other, you probably want to take the more distal level, okay? And that's key there. All right, let me try to get some questions here. Now, remember, one of the most important things to understand is that not every level you see on a chart is a level you want to take advantage of and trade. In fact, the majority of them you're better off ignoring, okay? A lot of times people will say, well, how come, that level looks the same or good? How come that level didn't work? Well, we go over these things called odds enhancers. I've seen some people in here today typing about them. It's kind of too much to go over today, but these odds enhancers are a little checklist of a few things we look at. One of them is looking at how prices left the level. But what this odds enhancer checklist does, it's really a probability scoring system. Okay, it's real simple, but what it does is it forces us to only focus on key turning points, key levels. And more importantly, it forces us to ignore all the other levels out there that don't meet our high probability, low risk, and high reward criteria. Okay? So that is a big thing there. Volatility instrument, Jason, Like which one? I would just, you're going to get your most, markets are always going to be most volatile when they are far away from equilibrium, which means they're out near price levels where your supply-demand imbalances are really strong. So you definitely want to look for that. And Jez, if prices don't reach the limit you have set, in my opinion, I just let it go, so I missed the trade. It'll come back there eventually, at some point. And there's other trades out there. You don't want to get in the habit of chasing trades, especially in the Forex market. Hey, Eric. Yeah, I'm sure we'll be doing something in Dallas at some point next year. Good to see you, though. Let me just try to read back here. Let's see. Yeah, so let's take a look at this chart really quick. Okay, I'll throw this on an hourly chart. And we'll be doing another one of these sessions. I forget what the date is, but I think they have it pretty set, so we'll be able to get into a lot more information, a lot more stuff. Okay. Well, here's this euro yen. I think this is a level that people are talking about here. Let me put some lines on here, and then we can kind of chat about it for a minute. Here's a nice big rally, base, and drop. Hang on, I'll capture the chart again for you. And I'm also trying to glance back at some of these questions. Jez, yeah, you just have to be careful that, if you're going to trade off that 15-minute chart, you need to know where you're at on the larger time frames. Okay? Because what if you have a smaller time frame demand level sitting right in a larger time frame supply level? That market's probably going to go down, but you wouldn't know that unless you looked at that larger time frame. So here's the euro yen. I think someone was pointing out that we've kind of already been back here. This is a case where, yeah, this is a level, nice level, rally-based drop, okay? Prices did come back here, but notice they only touched the level and fell. That was a pretty strong drop. What that's telling you is that there's probably quite a bit of supply up here, okay? So that's the information that's giving you there, okay? Yeah, so KTD, that's kind of what I'm talking about here. You want to try to make sure you're trading with the trend. Now, you usually, I'm in FXStreet quite a bit, and we usually don't mention the word trend. And it's not because it's not important. It's just that, and for veterans in here, you probably already know what I'm going to say. The better you get at identifying your demand and supply levels, right? Your potential market turning points, the less you're going to be focused on trend. And the reason is because, where does every downtrend stop and every uptrend begin? At a demand level. Where does every uptrend stop and every downtrend begin? At a supply level, right? So the more you're focused on your turning points, the more you're going to be in these trends at the beginning before your competition, before everybody else jumps into it. And that's the whole point of trading. You have to get in before everybody else gets in at the right time when the risk is low, and otherwise there's no way to do it, right? And people forget that. All right, let me see here. Let me do one other thing here for you. So I just, yeah, nice job there getting away from that MA. You don't need that. So I just typed my email address there in there. It's sseiden@tradingacademy.com. I'm pretty caught up with emails. I feel really bad that we didn't have enough time to get to all the questions, and I wanted to go over a few more charts with you. We do have another session coming up real soon. I'll find out when that is. And as I know we're out of time here, but anyway, thanks so much for attending. Thanks for your time. And again, shoot me an email if I missed your question. And Jose, yeah, send it again. It should be fine. Should be fine. And we'll see you again soon.